All right, all right. Happy Friday. It's April 17th. My name is Amal, and today I'm going to teach you guys how to hedge your position as insurance. Again, folks, our community has been renamed and rebranded. We are now known as the Alpha Trades community, formerly known as Cryptosomniac. So if you go into our community, our Discord community, you can see right here, we're renamed the Alpha Trades. And if you see this symbol right here, that is associated with our community. Okay, so let's get to it. All right, so what do we have? Okay, so first things first, if you are in your position, okay, and you're trying to protect your position by minimizing the losses or capping the losses, or you want to capture the upside or the downside move in the other direction of your position, this is essentially known as hedging. Okay, so we're going to go through it. All right, what are the different ways we can hedge? What are the different instruments that we can use to hedge? And what are some potential scenarios? Okay, so let me first start off by saying I'm not a financial advisor. I'm here to only do educational videos and show you guys exactly how I trade, how I would position myself in certain scenarios, and you can do with that information whatever you want. Okay, so today's video, I'm only going to cover the Bitcoin market, obviously, in terms of hedging, but hedging itself applies to any market, right? However you want to hedge your position, it works the same way across the board, okay? So let's get to it, all right? So let me get rid of this, this, and this, okay? So let's check out a chart of Bitcoin, right? So we've seen, for the most part, that Bitcoin is creating this large sort of symmetrical triangle, symmetrical pennant right here, right? The reason this is important to look at is because you can understand what's happening in the macro price action of Bitcoin. Okay, forget the 15-minute charts and intraday stuff that's going on, because all that stuff can be done with spot buy positions, long or short perpetual contracts, etc. Right? But if you really want to capture a long-term hedge, or you could even do hedges on the shorter-term time frames. But if you want to be able to capture long-term hedges, here's how you can do it, okay? So first things first, prices of Bitcoin currently at 7,075, right? So what does that tell us, and what do we want to do with this price, okay? Well, first thing that you need to establish is you need to understand what kind of position that you want to get into, and then how do you want to hedge it. So usually there's just two parts of hedging, right? Number one is the position itself. So the initial trade or position that you take is the first trade that you want insurance on, okay? So if we go down to, let's just say, the 1 hour time frame, right? We're gonna say, all right, on the smaller time frame, okay, I see this kind of consolidation movement. I wanna actually short this, okay? And I wanna short it right here, okay? So let me give you a simple example. I want to short it. I'm going to place my stop above this key high right there, right? And I'm actually targeting down here, okay? One way to do this is you could take this position as a short, as is. The second piece to this is you can hedge it with a long on the other side, meaning that you can say, okay, well, I'm going to place a conditional order, whether it's on a different exchange, whether you want to spot buy, whatever exchanges that you guys are using. You could say, all right, well, in case I get stopped out and price, blows through my stop and it starts going up like this, okay, I want to capture the upside potential of this movement in case my short position is wrong. So the hedge, or rather the insurance policy to this position, your short position, is that you look at, this area right here, and you say, okay, this is around, 70 to 35 or something, let's just say. Or actually, let's be a little bit more precise, right? We can say that this high right here is right there around 72.23, okay? So anything above that, if we start breaching that level, I want to capture the upside movement, okay? So you can go into Bybit, you can go into BitMax, wherever they have, conditional orders for you to take. You can say, set my conditional order if in case the limit price hits past 72.23.5, get me into a long position and let me capture the upside, okay? And so this way your short position can be stopped out, but your hedge, which is your insurance policy, can start to appreciate, okay, in the upside direction. That is a simple scenario of hedging, all right? So let's get a little bit more complicated, okay? So let's just say that you wanted to hedge in a different manner, and rather that you don't really know exactly what's going to happen in the shorter time frame, but you might be a little bit more confident that you believe in Bitcoin in the longer time frame, whether it's going to go up or down, right? So in this particular scenario, if you want to take on your initial position, right? So you could say, all right, well, in this particular case, I actually want to long, right? I actually think that Bitcoin is going to push up to 9,000 or 10,000, whatever price you think it's going to go to, okay? So you take on a long in this particular area right here. You place your stop right in this particular area, and you could effectively, use this stop as your risk defined point and say, okay, I'll get out of my long in that particular situation, but what I'm going to do is I'm going to go to Deribit, and I'm going to look out into the future and look at, let's just say, what's today? April 17th, 2020, right? Let me look out into the May contracts, okay? May 29th, 2020, okay? So how are those options looking? All right, well, I see, here's the 3,500, 4,000, 4,500 contracts, right? Let's just say Bitcoin is going to drop like a brick in the next several weeks, okay? So in the next month, you're expecting that, okay, just in case of a hedge and Bitcoin doesn't go up from here, I'm going to take on an insurance against my position. And I'll say, I'm going to grab some May 29th, 2020 puts, okay? So put contracts, remember, you're effectively betting on the price to go down. The closer to the strike price that you are, the more money you'll make. Actually, it's not just the strike price. It's a little bit more complicated. It's also the bid and ask, right? So for example, the bid for, the bid for the strike price right now is $45, okay? In this particular case, it's a pretty cheap contract because the bid for the call option right here is 3,473 because we're well above the 3,500 strike right now, right? Because we're at 7,078. So that's effectively saying that, all right, well, clearly the current index price is way above the strike price. But just in case in the future you want to hedge and you think that Bitcoin might come down to the $3,500 level again, this, okay, could appreciate significantly. So if one contract right now for the $3,500 strike price costs $45.96, by the time price gets down to, let's just say, that $3,500 level by May, okay, even May first week or second week, this price could explode to $4,500, kind of like it is right here. So your one contract of $45 could be worth $4,500. Again, this could also go to zero because price could just keep going up. And then obviously no one has hopes in buying put options for $3,500 because that would be dumb, right? Because price just keeps going up and up and up, right? So this could effectively go to zero. But again, in terms of hedging and insurance, you could buy this and say, you know what? I think Bitcoin is going to go up, but I'm not that confident. So just in case it goes down, I want to be able to capture, that kind of movement to the downside. And this kind of put contract right here helps you create an insurance policy on your overall position. Okay, so that's one way. You could even alternatively go to the futures contracts on BitMEX and say, all right, well, I see Bitcoin trading at 7,057 right now, right? How are the futures contracts looking for September 25th? Well, they're looking all right, no real strong premium anywhere. So you're effectively, saying that, all right, if I want to buy the current contract at the current price, if price goes up as a long, right? If price goes up from here, I can make significantly more money. Okay, because remember, futures contracts do not have fees associated with them, okay? So in this particular instance, right, you could buy the September 25th, 2020 contract at current price as a long, and as price moves up, that contract could appreciate. And sometimes if the price is drastically moving or, significantly appreciating very fast, the futures premium could really spike up. So the current contract of 7,053 could be $100 higher, could be $200 higher, Just depends how volatile the market is, okay? So you could do, different kinds of hedging in different instances. You can be in a spot buy position in Bitcoin, right? So spot buy means you're effectively long. You could then put on a short, or rather a put option for May 2020, okay, May 29th, 2020, but then you could be out into the future, September 25th, and you can say, all right, well, I still think that Bitcoin could do something like this, go up, go down around May, and then by September time, I think it's going to go all the way up. It's very possible that all three of your positions come out in profit, okay? I mean, unless you get, stopped out in your spot buy right here, your option put does not come to the agreed upon price in time, or rather it doesn't go down fast enough. Rather, it may take us a month and a half to just get up here, and then your contract expires and then it goes down. And then while it's staying down here in September, your futures contract is also, losing value, but then right at the beginning of September, it starts moving back up. But then by the time, because you bought right here, your September contract, you're still at a loss. So it's possible that you could actually lose all three scenarios, okay? So hedging itself, especially if you're playing with options as well as futures, okay, is a very difficult task because price could go any which way in terms of its time, right? Time is very, very hard to predict in these kinds of markets, okay? So those are a couple of different examples how you could hedge, okay? I hope this mini seminar was helpful. I wanted to keep it short and simple to give you guys an example of how you could use it in a shorter time frame as well as a larger time frame with different instruments. So I hope you guys enjoy the content. Give me a thumbs up, and again, come join the Alpha Trades community. All right, cheers.